Dorchester's got a very interesting, almost intriguing background for those of you who've been around the markets for a while, originally listed in 85. Fortunately, most of that history is not relevant to the current business and the current management and board. But the company just survived the global financial crisis and the finance industry meltdown, did enter into a moratorium for 18 months or so, which we came out of in June 2010. The good news is that there are no legacy issues, no impediments to the existing business. So the only issue is that we've got a couple of assets which are well-performing assets, which I'll comment on when we talk about the balance sheet. Just covering the corporate structure, two main shareholders, Hugh Green Investments and the Business Bakery. And with the three of us, we have put in about 20 million cash in 2 rounds in capital raising in 2010 and 2011 in about that approximate ratio of our current shareholding. Matthew Harrison was the vendor of EC Credit, the debt recovery business that we acquired late last year, and Matthew joined the register as a reasonably significant shareholder as a consequence of taking some equity as part of the total consideration for the business. The 4 major shareholders have board representation, as you see there, and that means there's over 60% of shareholding represented around the board, which actually is pretty helpful. Some of the metrics: shareholder funds around 68 million at the moment, market cap 114 at the current share price of 23 cents, and profit guidance, which I'll again speak to, about 6 million for the current financial year through to March 2014. I've just simplified the balance sheet, but those numbers are all from the 30th of September interim accounts. Just a couple of comments there. The reverse annuity mortgages, those are a legacy asset. They're a well-performing asset. The yield is just under 10%. Doesn't require a lot of administration. LVRs, so their first mortgages on residential property, LVRs around 35% across the portfolio. And as those loans get repaid, then we use that funding to fund the receivables. There's also 2 properties from a significant property book, 2 development properties, i.e. bare land, one in Auckland, one in Christchurch, both written down to carrying value less than we would hope to get. In particular, there's one in Christchurch which has been consented for 62 properties sections, and we're looking to get that reconsented. It's in a good area. It has had no problem with liquefaction or stability, and prices are certainly starting to move up there. Just the only other comment, the finance assets including fund under management, that's those are savings from a scheme that we're running out. It's under management by OnePath, and it's matched on the liability side by the investment contract liability. So there's a cash matching there. And again, it doesn't require any administration, and we're happy as to just take our standard administration fees, etc., as that runs out. Just a couple of things that aren't on the balance sheet. Tax losses, somewhere north of 15 million. So what we have got on the balance sheet there, you'll see under receivables, properties and prepaid tax, we've got about 3 million worth of prepaid tax. For those of you who are better at tax than I am, you don't lose that because those prepayments sort of stay and aren't at risk with shareholder continuity. But there's about another 17, 18 million of tax losses that are not on the balance sheet, and we're well within our shareholder continuity, maintaining 49% to ensure that we can use those losses, and that would always be a factor in any M&A. We would look to make sure that we retain those tax losses for use. The other item that's not there, and thanks to sterling work that Todd and his team are doing at Turners, We equity account Turners, so that's pretty much our investment. And at the current share price, I think it's worth about 13.3. So that's, again, if you like, some value that is not on the balance sheet. So the balance sheet's pretty conservative. Equity ratio 57%, equity to total assets. Gearing, debt to debt plus equity, about 19%. So some capacity there for M&A, which we do see as a major part of our growth. Look, there is still a little bit of a mystery, which what does this business do? Very simple. 3 operating businesses. The first is just a vanilla finance company. So we lend to consumers mostly, 70%, and to SME companies, 30%. It's mostly on motor vehicles, that includes commercial vehicles, and then there are some other categories that we lend on. It's all secured lending. Average loans around 15,000, interest rates 14 to 18, so we're in that second tier. And loan origination through some direct and then some through finance brokers and motor vehicle dealers. So subscale at the moment, 34 million receivables, but focus on building a quality receivables book and looking at the arrears and bad debts metrics. The insurance, we're in 2 specific categories, and they're both short tail, low risk. So one is around what I call sort of easy life sort of covers it. So low levels of life cover, funeral plan, disability cover, death from either accident or redundancy, but they've all got limited cover included in the policies. The second area is consumer insurance and all around motor vehicles. So private motor vehicle insurance, motor vehicle breakdown insurance, loan repayment insurance, and gap insurance, which ensures a difference between market value of a vehicle and the amount that would be recovered in the event of a write-off. Policy sales through our own tied agent force and finance brokers and motor vehicle dealers. The growth is in the mainstream, so and we deliberately use mainstream rather than Dorchester because most of our sales will be through motor vehicle dealers and finance brokers. Sometimes they will attach to loans or to finance that we won't be doing that loan. Third stream is the EC Credit debt recovery and credit management business operating in New Zealand and Australia. So about 40% of the business is in Australia. So that's debt recovery from bank clients and corporates. So we don't own the ledgers, but we will collect on a contingency or commission basis, usually sort of 15 to 20%. And we also sell terms of trade and legal services to SME. That's quite a significant part of the business, especially in Australia. Business origination is through term contracts that we have with banks and major corporates. Those contracts are usually sort of 2-3 years with a rollover. Most of them stick as long as we collect an appropriate percentage of the book compared to other providers that most banks will use 2 or 3. They won't put all their recovery through one. And our own sales agents, which is where we do all our business with SME. Have about 15 reps in New Zealand, have about 35 in Australia, and we're looking to build the Australian rep force. These are guidance that we put out in May, and there's no reason for us to change those guidance. We don't disclose forecast breakdown between finance and insurance, but both of those entities are profitable on a full cost allocation basis. Although both of them we consider subscale, so they have both got good opportunities for organic growth. They will grow around 30% per annum over the next 2 years. EC Credit, more mature business, been around since the late 80s, and we expect growth there to be between 10 and 12%. So forecasting net profit 31st of March 2014, 6 million, increasing to 10 in a couple of years, and that doesn't include any M&A activity. We released our 6 months results last week, so the reported number was the 1.85, but in that period we prepaid all the interest due on the optional convertible notes through to their term in March 2015. So adding that back is around sort of 3.5 trading. Included in that was Turner's equity accounted profit. It's only 190,000 because under some accounting rule, because there's difference in balance date, we could only equity account 3 months. So in the next second half, we'll be equity accounting 6 months. But I just sort of take it out there to indicate that, you know, underlying trading over 3 million and on track for the 6 million. What we reported there is essentially we're on forecast with the finance business, just under budget with the insurance business, not in terms of policy sales. We're bang on, we're slightly ahead on policy sales, but we've had a couple of one-off compliance costs, and that's related to getting our full licence under the Reserve Bank regulations. So we were issued a full licence in August. To get a full licence, we needed a credit rating, so we had to go through the credit rating process. And again, those of you who've gone through or are involved in any of those processes would understand that there are some significant one-off costs involved. We've taken all those and written them off to in the P&L. EC credit was just ahead. Australia was a bit slower in the few months prior to the Australian election. Seems to be picking up now. New Zealand's sort of running quite comfortably ahead. So last slide. We talk about M&A as being quite a key part of our growth. The reality with M&A is that you can't control the timing. We see that there is going to be 5 earning streams that will contribute to the group profit, and I'm just going to talk about 3 of them, just leaving EC credit and DPL insurance. But just before I move on from those two, EC credit, debt purchase we're not involved in. We want to get involved in, but we will be taking it fairly cautiously, and certainly won't be relying on earnings from debt purchase to achieve our budget. And that would be both in New Zealand and Australia. So we've had a couple of goes at it, but we're just haven't quite been priced high enough, but we're pretty comfortable just taking a very sort of conservative approach. On the DPL insurance, probably the opportunities there is to leverage the fact that we're, with our licence, we're both a life insurance and a general insurance underwriter. So we can use our ability to work with potential partners, perhaps under white labels, and sort of customise policies for them to sell through their network. So just getting on to the other 3, as I mentioned, on the finance side, so subscale. So we need to get that up to around 75 to 100 million, which we see as being scale in what is a fairly modest market in New Zealand. Now that can be achieved by broadening our dealer network and our broker network, which we're doing. But we're doing that rather cautiously. We want to make sure that we can service any new brokers that come on stream, rather than sort of rush around and try and work with too many without the resources to do it. And we're quite keen and been spending money on our IT. Of course, acquiring an existing finance company would be a step up and give immediate scale. The scheme lending, I mean, this is still lending, but it's all about what we're talking about there is working with a partner whereby we might not own the channel, but working with a partner to lower and have better control over origination costs. With dealing with motor vehicle dealers and broker networks, it's on a deal by deal basis. We've got to do all the work and of course we've got to leave something on the table for those dealers and brokers. If we can finance certain assets, whether it might be retail, it might be household sort of products, working with a provider of those products to provide the finance element, there is better control, there is lower cost of origination. The final area there, financial services, really that's broadening our offering so that, and there's likely to be in those businesses some synergies with either the finance and the insurance. The synergies might be in terms of products, or it might be in terms of customer base. And as one theme that is around there is that we quite like that SME market for both finance and insurance. The first priority is to ensure that our underlying our existing three businesses remain profitable and that we increase those profits, and to then add step growth, significant growth via accretive merger and acquisition activity.